Happy Monday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony, coming to you once again from a very sunny New Zealand. Let's jump in. Now, before we discuss the first story on the economy, I just wanted to extend my thanks once again to those of you who joined for the live stream to celebrate 100,000 subscribers on Sunday. It was wonderful to do. I hope to do more in the future. Thank you, everybody. For those who missed it and would like to see the live stream, I've put a link to it in the description below. Now, let's dive into today's episode, and we have a lot to cover actually. We begin as we usually do with the economy. China's consumer prices saw their fastest increase in 5 months this January, as holiday-driven spending provided a temporary boost to the world's second largest economy. However, underlying deflationary pressures remain a persistent challenge. The National Bureau of Statistics in Beijing reported that the Consumer Price Index, CPI, rose by 0.5% year-over-year in January, surpassing economists' expectations of 0.4% and marking an acceleration from December's marginal 0.1% gain. The increase was primarily fueled by a rise in food and service prices linked to the Lunar New Year, which fell earlier than usual this year, running from January the 28th through the 4th of February. The surge in demand for travel and dining services contributes significantly to the uptick, with airfare prices climbing 8.9% and border travel-related expenses rising 7%. Similarly, food prices spiked as millions of Chinese citizens prepared for large family gatherings and traditional celebrations. Despite the short-term boost, however, economists warn that China's inflation outlook remains fragile. Factory prices, measured by the Producer Price Index, fell for the 28th consecutive month, declining 2.3% year-on-year in January, mirroring December's contraction. The prolonged deflationary trend underscores the economic headwinds China faces, particularly in manufacturing and exports. China's economy continues to struggle with weakened consumer confidence, exacerbated by a protracted property sector crisis and the lingering effects of pandemic-related restrictions. The situation has been further complicated by renewed trade tensions with US President Donald Trump in the White House, who has recently imposed additional tariffs on Chinese goods, prompting China to retaliate with its own levies on key US exports, including liquefied natural gas and crude oil. In response, Beijing has pledged aggressive measures to stimulate consumer spending and bolster economic recovery. The government has introduced monetary easing policies, including injecting a record 2.2 trillion yuan in short-term funds into the financial system ahead of the Lunar New Year, aiming to ease liquidity pressures. However, analysts remain cautious about China's ability to sustain inflationary momentum. As the seasonal spending surge fades and external economic pressures mount, the country's battle against deflation is expected to persist throughout 2025. Meanwhile, while we're still on the economy, China's central bank expanded its gold reserves for the third consecutive month in January, demonstrating a continued commitment to diversifying its holdings, even as gold prices soared to record highs. The People's Bank of China, China's central bank, increased its bullion holdings by 0.16 million troy ounces, according to official data released over the weekend. This move follows a 6-month pause in purchases and comes amid increasing geopolitical and economic uncertainties. The rise in gold reserves aligns with a broader global trend as several central banks continue to accumulate gold to hedge against economic instability. Analysts suggest that the People's Bank of China's renewed buying spree may be influenced by political considerations, particularly in response to the policies of US President Donald Trump. While central bank purchases remain strong, consumer demand for gold in China has been subdued due to a sluggish economy and high gold prices, which have surged close to $3,000 an ounce. The weak economic outlook and a strong US dollar have made gold purchases increasingly expensive for Chinese buyers, leading to a decline in jewelry demand. Despite the tepid appetite for physical gold, investment in gold-backed exchange-traded funds, ETFs, has surged, reflecting a shift in consumer preference towards paper investments. Additionally, bars and coins remain popular with domestic investors seeking stability amid stock market volatility and the ongoing real estate crisis. The People's Bank of China's decision to resume gold purchases is also seen as a strategic move to support the currency. As China navigates a challenging economic landscape, its central bank's gold buying strategy underscores a broader effort to reinforce financial stability while adapting to evolving global market conditions. Next up, we have two more developments to cover, but just quickly, if you're getting some value from today's episode of China Update, don't forget to hit the like button. It's a tremendous help for the channel. Liking, sharing, and subscribing are the only ways in which the channel can grow. Patreon and Buy Me a Coffee links are also in the description. For those who want to help keep the channel financially sustainable, I rely primarily on your support to keep going too. Thank you so much, everybody, for the ongoing support. Also, I'm filming this at a funny time of the day. The light here is maybe a little bit distracting. My apologies about that. I will try and fix that tomorrow. Next up, the South Pacific country of New Zealand has voiced strong concerns over the Cook Islands' decision to proceed with a strategic partnership agreement with China without proper consultation. Cook Islands Prime Minister Mark Brown has departed for Beijing to sign the agreement, despite repeated requests from New Zealand's Deputy Prime Minister and Foreign Affairs Minister Winston Peters for transparency. The New Zealand government asserts that the 2001 Joint Centenary Declaration requires consultation on significant agreements. A spokesperson for Peters stated that while Brown and Peters spoke on Friday, Brown failed to provide the requested details before leaving for China on Sunday. Quote, "The time for consultation has now passed," end quote, the spokesperson said, calling the situation a, quote, "matter of significant concern," end quote. The Cook Islands, a self-governing Pacific nation in free association with New Zealand, has long shared close ties with Wellington. Most Cook Islanders hold New Zealand citizenship because of the special relationship between New Zealand and the Cook Islands. But with these rights and privileges comes responsibilities. Brown has defended the China deal, stating that it will enhance trade, tourism, climate resilience, and infrastructure while maintaining the Cook Islands' sovereignty. However, the move follows broader tensions in the Pacific, where New Zealand has paused a $102 million aid program to Kiribati due to its growing ties with China. Of the Anglophone nations, New Zealand has, in recent decades, maintained perhaps the most friendly relationship with China. However, it is in the South Pacific where geopolitical tensions are most evident. New Zealand has reaffirmed its commitment to protecting the interests of Cook Islanders while ensuring regional security. Discussions on this matter are expected to continue in the coming weeks. And finally for today, we end today's video by examining the salient points made in a report published over the weekend by Chinese financial media outlet Caixin. The authors argue that China's education system stands at a pivotal moment. Quote, "As the government embarks on a transformative journey with the newly published outline for the construction of a strong education nation 2024 through 2025, end quote. However, quote, "achieving this ambitious vision requires substantial funding, a resource that has been increasingly strained in recent years," end quote. While total government spending on education has increased over the past decade, its share of GDP has declined. In 2023, education spending fell below the globally recognized 4% benchmark, raising concerns about sustainability. The authors argue that the floodgates of local fiscal crises have given way as de facto bankrupt local governments can no longer afford education investment. Indeed, they can't even afford, in some cases, to pay local school bills. Quote, "This financial shortfall has had tangible consequences at the grassroots level, where schools are grappling with overdue bills, delayed salaries, and funding shortages," end quote. Li Lei, a high school principal in Yunnan province, highlighted these struggles, noting that while his school should receive 3.2 million yuan, about $437,000 annually, only 500,000 yuan, less than $100,000 has been received by late 2024. This has left him scrambling to cover operational costs, even facing pressure from the electricity company over unpaid bills. Local governments, constrained by fiscal challenges, have delayed fund allocations, writes the outlet, forcing many schools into debt. Despite national education funds nearly doubling from 2.1 trillion yuan in 2013 to 4.1 trillion yuan in 2023, inefficiencies and financial mismanagement have weakened the system's resilience. An official audit in 2023 revealed that nearly 2 billion yuan of education funds were misappropriated across 66 counties. Funds intended for rural student nutrition programs were redirected to repay government debt, meet administrative costs, or even lost through fraudulent procurement schemes. Experts argue that while central government transfers to local governments have increased, weak oversight have led to widespread misuse. Without strict controls and transparency, the intended beneficiaries, students and schools, continue to suffer, the Chinese authors write. China's shifting demographics further complicate educational funding. The number of kindergartens declined for the first time in 2022, followed by a sharper drop in 2023. Preschool enrollment plummeted by 11.5%, reflecting the country's decline in birth rates. Meanwhile, rural schools face underutilization, while urban centers struggle with overcrowded classrooms. Experts suggest adopting policies to integrate migrant children into urban schools and shifting education investment toward secondary education, aligning with global trends. For example, OECD nations have reallocated budgets from early education to high school, a move that China may need to consider. To sustain educational growth, the Caixin authors argue China must diversify its funding sources. At a January 2024 conference, scholars recommended a big education finance model combining public investments with private contributions. This includes leveraging long-term national bonds, encouraging corporate sponsorships, and increasing family involvement in education financing. Chinese universities, heavily reliant on government funding, are also exploring new revenue streams. Strategies include issuing bonds, fostering industry education partnerships, and optimizing tuition structures to ensure financial resilience. For China to become a global education powerhouse, the authors argue, it must generate stable and adequate funding. Balancing fiscal constraints with educational ambitions remains a daunting challenge. Policymakers must navigate these complexities to ensure that China's education system not only survives but thrives in the coming decade. But until Beijing fixes its fiscal system and wider economic growth model, now local schools, as we just saw, in some cases, due to local government financing shortfalls, cannot even afford to keep the lights on. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, and I will see you all tomorrow.